adventure. Welcome, everyone. Today, we are diving into something that could completely change the way you see the market. Imagine having a tool that lets you see market action as it unfolds, not constrained by time, but by real trading activity. That is exactly what tick charts do, and over the next 40 minutes, you are going to learn how to use them with confidence. Tick charts are different from what you might be used to because they do not focus on time. Instead, they focus on trades. Think about that for a second instead of waiting for a new bar to form every minute or every 5 minutes. Tick charts form a new bar only when a specific number of trades happen. This gives us a much clearer view of the market's true activity without the limitations of fixed time intervals. If you have ever felt like time-based charts were not showing you the whole picture, or you struggled to capture the market's real momentum, then stick with me. Tick charts can help cut through the noise and give you a better understanding of what is really happening. By the end of our session, you will not only understand what tick charts are, but also how to use them to gain an edge in your trading. So get ready to see the market from a whole new perspective, one that is all about the action, not the clock. So, are you ready to dive in? We are going to start by covering what tick charts are and why they matter. Then we will get into how to use them to make better trading decisions. Stick around because by the time we are done, you will know exactly how to use these charts in your own strategy, and you will feel confident doing it. All right, let us start with the basics. A tick chart is different from the traditional charts most people are familiar with. Unlike time-based charts, a tick chart does not care about minutes or hours passing by. Instead, it focuses solely on the number of trades being made. Each trade is called a tick, and the chart will form a new bar after a set number of ticks have occurred. For example, let us say you are using a 200 tick chart. This means a new bar will form every time 200 trades have happened, regardless of whether those trades take place in a matter of seconds or stretch out over several minutes. In a fast-moving market, you might see a new bar forming every few seconds, while in slower times it may take much longer. It is not about measuring time, it is about capturing the activity. By focusing on the number of trades, tick charts give you a better understanding of market action and momentum. Tick charts also help to highlight areas of higher trading activity, allowing you to see when the market is heating up or slowing down. This helps you cut through the noise and focus on the moments that really matter. Instead of being constrained by arbitrary time intervals, tick charts adjust dynamically to the flow of trades, giving you a more fluid and responsive view of the market. Whether the market is active or quiet, tick charts give you a true representation of trading intensity. This makes them particularly useful for traders who want to capture real action rather than waiting on the clock. So remember, tick charts are all about the action, not the clock, and that difference can provide you with a much clearer perspective on what is happening in the market. How is that different from regular charts? Well, on a regular time-based chart, bars show up after a certain amount of time has passed, like 1 minute or 5 minutes, even if there have only been a few trades. Tick charts are different. They only care about how many trades happen. This means that when the market is busy and trades are happening quickly, new bars will form one after another very fast. And when things slow down, the bars will take longer to show up. So why does that matter to you as a trader? Well, because tick charts can filter out the slow, boring times. They let you focus on the moments when things are really happening. You get to see where the action is, and that can help you catch trends earlier. If you like the idea of getting a clearer picture of the market, then tick charts might just be what you need. Now you might be asking yourself, what does this look like when you are actually trading in real time? Let us dive in and break down exactly how tick charts work when you are watching the market unfold in front of you. Imagine sitting at your trading desk, your eyes on the screen, ready to make sense of every movement. How do tick charts help you at that moment? Let us explore together how they bring the market's rhythm to life and why they are so powerful for capturing the pulse of trading activity. Imagine you are sitting there watching your screen. Picture yourself tracking every movement, trying to make sense of what is happening. With a tick chart, every bar you see represents the same number of trades, not the passing of time. This can feel quite different if you are used to traditional time-based charts, but it is what makes tick charts so powerful. The time it takes for a new bar to form can vary widely depending on market activity. If the market is buzzing with trades and there is a lot of action, you will see new bars forming rapidly, one after another. During these times, it might feel like the chart is alive, constantly updating as each trade happens. On the other hand, when the market is quiet, it will take much longer for a new bar to appear. It might feel like the chart has slowed down, waiting for enough trades to occur before it moves forward. Think of it like this: the bars on a tick chart are directly tied to market excitement. When trading activity is high, the chart moves quickly. When things slow down, the chart moves slowly too. The key idea is that the bars are always moving in step with the actual action in the market. This is what sets tick charts apart. Instead of following a steady clock that might miss important details during slow or busy times, tick charts adjust to the real pace of trading. They move with the action, not with the clock. This means you are always getting a true representation of what is happening in real time as trades occur. Now let us talk about different tick sizes in more detail, because understanding this is key to making the most out of tick charts. Traders choose different tick sizes depending on what kind of action they want to see and the pace of the market they are trading. A tick size simply means the number of trades that must happen before a new bar forms on your chart. If you are in a market that is moving fast, you might want to use a smaller tick size, like a 233 tick chart, so you can see new bars forming quickly. This gives you detailed insight into fast-moving changes, which can help you react in real time. On the other hand, if the market is moving slowly or you prefer a broader view, you might want to choose a larger tick size, such as a 1000 tick chart. A larger tick size means fewer bars and more general trends, which helps filter out the noise that can sometimes overwhelm traders in a slower market. The key is to choose a tick size that matches the level of detail you need for the market conditions. Smaller tick sizes will give you more granularity and more bars, showing you every small movement, while larger tick sizes will provide a more condensed and stable overview. It takes a little trial and error to determine the best tick size for your trading style. A good approach is to try different tick sizes under different market conditions. For instance, if you are trading during a very busy time, start with a smaller tick size and see how quickly the bars are forming. If it feels like too much information too quickly, consider increasing the tick size to slow things down and make it more manageable. Conversely, during slower times, if the bars are forming too slowly and you feel like you are missing out on details, try decreasing the tick size for a more immediate view. The important thing is to choose a tick size that makes sense for the specific market you are trading at that particular moment. Different tick sizes can make the market look very different, and finding the one that matches your needs can make all the difference in your decision making. Remember, smaller tick sizes give you more detail and help you react to every small change, while larger tick sizes provide a broader and calmer view that filters out unnecessary noise. It takes a little experimentation, but eventually you will find the tick size that works best for you and your strategy. All right, now that we have a better understanding of how tick charts work and how to choose the right tick size, let us explore how we can use this knowledge to spot trends and key patterns effectively. Imagine having the ability to see patterns emerge as they happen, to identify market movements in real time, and to feel confident that you are seeing things unfold exactly as they are. This is where tick charts shine. Spotting trends early is crucial to making informed decisions, and tick charts provide the kind of responsiveness that can help you identify and act on these opportunities without delay. Let us dive deeper and uncover exactly how you can spot trends, identify key reversal points, and use tick charts to make your trading more precise and effective. By focusing on these critical moments, you can get a true sense of the market's rhythm and use that information to your advantage. One of the best things about tick charts is how they help you see trends as they happen. Since tick charts are based on trades, they react immediately to what is going on in the market. This can make it much easier to see if the market is moving up, down, or just staying flat. And that is so helpful when you are trying to catch a trend early. Tick charts are also really good at showing reversals. Because they update based on the number of trades, you can often see a reversal forming before you would notice it on a time-based chart. That extra bit of time can make a big difference when you need to make a decision quickly. Now you might be wondering, can I use other indicators with tick charts? Of course you can. Many traders like to add things like moving averages or something called the relative strength index. Adding these indicators to your tick charts can help confirm what you are seeing and give you more confidence in your decisions. It is all about using the right tools together. Speaking of using different tools, let us compare tick charts to other types of charts that you might be familiar with. First, think about time-based charts. These are the charts that most people are used to, where each bar represents a certain amount of time, like 1 minute or 5 minutes. No matter how many trades happen, a new bar forms every time that minute or those 5 minutes pass. Tick charts are different because they only form a new bar after a certain number of trades. This gives you a more precise view of what is really happening, especially when the market is busy. You might have also heard about volume charts. Volume charts are another type of chart that some traders use. These charts update when a certain amount of volume has been traded, not just based on the number of trades. So with volume charts, you are looking at how much has been traded overall. Tick charts, on the other hand, focus on how many trades have happened. Both have their advantages, but if you are a day trader or someone who likes to make quick moves, tick charts can give you a better look at the action. So which one is better? It really depends on how you like to trade. If you want detailed, real-time information about the action in the market, tick charts are probably going to be your best choice. But it is always a good idea to try out different types of charts and see what works best for you. Now that we have covered the different types of charts, let us talk about how to use tick charts when you are trading live. When you are in a live trading session, tick charts can be really helpful for seeing things like breakouts, pullbacks, and reversals. Because tick charts react so quickly to market activity, you do not have to wait for a bar to close like you would with a time-based chart. You can see everything as it happens, which makes it easier to make quick decisions. Setting up tick charts is usually pretty simple. On most trading platforms, you can just pick the tick size you want and start watching the chart. You will see how the bars form during busy times and during quieter times, and you will start to understand how the market flows. One important tip when using tick charts is to always pay attention to the volume. Tick charts show you how often trades are happening, but volume shows you how much is being traded. If there is a lot of activity but not much volume, that can be a sign that the move is not very strong. Watching both tick activity and volume can help you make better decisions. Now, before we finish up, let us talk about some common mistakes that traders make when they are using tick charts and how you can avoid them. The first mistake is choosing the wrong tick size, which is especially common for beginners. If you pick a tick size that is too small, you are going to see a lot of noise. This means that the bars will form so quickly that you may feel overwhelmed, and it will be challenging to understand what is actually happening in the market. It can look like there is too much information, and every small move may seem like a significant change, making it difficult to make good decisions. On the other hand, if you pick a tick size that is too large, you might miss important details. The chart will form bars too slowly, and you could lose the chance to spot key trading opportunities early. The best way to figure out the right size is to try out different tick settings in different market conditions, both fast and slow, and see what gives you the clearest view of the market without overwhelming you. Practice this on a demo account to get a feel for how different tick sizes behave and find the one that helps you read the market comfortably and accurately. Remember, choosing the right tick size is about balancing detail with manageability, and it takes time and patience to find the setting that works best for you. Another common mistake that traders make, especially those who are new to tick charts, is overreacting to fast changes in the market. Tick charts can move really quickly when the market is busy, and it is easy to feel overwhelmed or excited by rapid movements. You might see bars forming one after another, and it may feel like you need to act immediately to catch every opportunity. This can lead to hasty decisions, often made without fully analyzing the situation. It is crucial to remember that just because the market is moving fast does not mean you need to. Instead, it is important to stay disciplined and stick to your trading plan. Your plan should include clear criteria for when to enter and exit trades, and it is important to rely on those criteria rather than reacting impulsively to every movement you see. Fast movements can make it tempting to jump in or out of trades without a solid reason, but doing this often leads to mistakes and losses. The goal is to make well thought out decisions, not just fast ones. Take a moment to breathe, assess the situation, and make sure any action you take is based on your strategy and not just on the speed of the market. If you feel like the pace is too fast, it is okay to step back and wait for a clearer opportunity. Remember, successful trading is not about catching every single movement, but about making the right decisions at the right time. Staying calm and focused will always serve you better in the long run. The last mistake I want to mention is ignoring the bigger picture. Tick charts give you a great close-up view of the market, but they can also be so detailed that you forget to look at what is happening overall. Make sure to take some time to check higher time frames or other chart types so that you understand the broader trend. Combining different types of information is always a good idea when you are making trading decisions. Great job making it this far. Let us take a moment to recap the key points we have discussed so far. Tick charts work differently from the traditional time-based charts you might be used to. Instead of focusing on time, tick charts create new bars after a set number of trades. This unique feature allows you to get a better perspective of what is happening during fast-paced market conditions because they respond directly to trading activity. By selecting the right tick size that suits the market and your trading style, and combining tick charts with helpful indicators like moving averages or relative strength index, you can identify trends more effectively and spot high potential trading opportunities before they pass you by. This responsiveness is one of the biggest advantages of using tick charts, giving you the ability to react quickly and more confidently. Here is what I suggest you do next. Start experimenting with different tick sizes on a practice account. Watch how tick charts behave when the market is busy and when it is quiet. Get used to how the bars form and practice recognizing trends. The more you do it, the more comfortable you will get, and soon you will be reading these charts with total confidence. Before we finish, let me leave you with some encouragement. Learning how to read tick charts is a skill, and like any skill, it takes practice. The more time you spend working with these charts, the more natural it will feel. Do not get discouraged if it seems hard at first. Every great trader started somewhere, and you are well on your way. Remember, every small step you take is progress, and even the best traders faced challenges when they first began. With every session you complete, you are building skills that will last a lifetime. You have already shown a commitment to learning, and that alone puts you ahead of many. Trust in the process, stay consistent, and know that you are growing with each experience. You are capable, and with time, you will become the trader you aspire to be. Thanks for being here today. Keep practicing, keep learning, and soon enough, you will feel completely confident using tick charts as part of your trading journey. Keep up the great work and happy trading.